Today I am with Shawn Nicolaides. He is a lender with CMG Financial in Vancouver, Washington, and I invited him to come on here and talk about a loan program. I don't know, would you call it a loan program? I'm pretty sure it's a loan program that is very interesting and something that I hadn't come across before. So just given how rates are right now, a lot of people are hesitant to jump into a new loan. I just thought that this program was a very creative solution, and it's nothing new. It's been around for a pretty long time. So there you go. You have your little platform. You can start sharing with us about this program and what it's called and all the details. And then I will ask questions as they come up. And then we're also going to jump into a just quick screen share of an actual example of how this program can save you money.
Awesome.
All right. Tell us all about it. Yeah.
I really appreciate it. So yes, I'm Shawn Nicolaides. I'm with CMG Financial, loan officer here in Vancouver, Washington. I work in Washington and Oregon, and my office can serve California, Nevada, Arizona, and Idaho as well. The loan program we're going to talk about today is called the All-in-One Loan. It's been around since 2005, and what it is a first lien home equity line of credit that you can use to purchase a new home. People hear home equity line of credit and they feel that it's synonymous with second mortgage. But in this case, we're able to utilize it when you're purchasing a new home. And the value that this loan will bring versus a 30-year fixed is going to be, or more of a traditional loan that you're used to with conventional or jumbo or FHA, is going to be flexibility. And as you mentioned right now, rates aren't pretty. We were very spoiled over the last couple of years with interest rates close to 3% for a period of time. And with that now adjusting to probably more than double into the low sixes, mid sixes, depending on your credit and down payment, flexibility is very important, both in payment and access to equity. For a lot of people in the last couple of years, they saw their home values go up a couple $100,000, which is awesome. But with a 30-year fixed loan, you can't touch it. So it's really not doing much for you. Where with this loan, you actually maintain access to that equity as you pay down your mortgage. So for people that are current homeowners, maybe you decided to stay in your house, you love your house, and you have $100,000 in equity, but you really want to do a bathroom remodel. You're going to have to go refinance. You're going to have to get a home equity line of credit. And when it's a second loan, most home equity lines of credit are adjustable rate. They're more expensive because they're a second lien and the bank isn't in favor of being in second position. So this loan is going to help you avoid certain cost impacts that would take place from accessing your equity through those other channels. And so, and more importantly, this allows you to utilize your income as a vehicle to eat up your interest cost. For most of us, your mortgage interest is going to be the most expensive debt you're ever going to take on in your life. And mortgage interest is what's making interest rates and the amount of interest you pay over the life of the loan is what's increasing the cost of home ownership. If you were able to borrow $300,000 over 30 years, the payment wouldn't be that bad. But when you have to pay back $325,000 worth of interest on top of the $300,000 you borrowed, that's where you're seeing this be so expensive with a high rate environment like what we have today. The all-in-one loan allows you to avoid those types of extra expenses, which it makes this very helpful for folks. I have a client that they purchased a home back in September. We were able to save them almost $300,000 in interest without asking them to change their lifestyle. They were able to buy a new home that fit their family and their needs, make the same amount of money, keep the same spending habits, but utilize their income in a more efficient way. And so that's what I want to share. It's a great opportunity for folks.
Yeah. And before people get too excited, I want to have you share the requirements to be eligible for the program. What I don't want to have happen is someone watches this video and they're just like, yes, I'm doing this. This is so awesome. But then, there is a minimum for the down payment and there is a minimum for the credit score. So I just wanted to kind of put that out there first.
Yes, no, I greatly appreciate that because it's very important. I'm not a fan of some of the clickbait thumbnail type articles that you find out there, and you're always searching for the fine print. In this case, you're going to have a minimum down payment if you're buying a primary residence is going to be 10%. You're also going to have a minimum credit requirement of $700. But once you meet that requirement, unlike other loans, the rate is the rate. So if your credit score is 701, you get the exact same interest rate as somebody that's credit score is 810.
Okay.
Down payment the same. The minimum is the minimum. The minimum down payment does fluctuate depending on how much you intend on borrowing. So you can do 10% down up to a loan amount of $850,000. Once we exceed that, it can go 15% up to about $1.25 million. And then it's going to be 20% down up to $2 million. And remember, that's your loan amount, not your purchase price.
Right.
And we can exceed $2 million upon exception. But and in addition to that, we have to show some reserve requirements. And then also the debt to income ratio tolerance is a little bit lower. It's going to be around 40%. But it's a way of us vetting people. Unfortunately, there were very few rules back in 2006, 7, 8. And we all saw how that worked out. And so we want to avoid that. So we put some, I would say, more strict guardrails on just to make sure we're giving this opportunity to the right people. Worst case scenario, we would never want to see somebody tap into their equity and buy a boat. this loan is for people that are going to use this tool and access to that equity in a positive way.
Right. And one of my first questions for you was, does that rate change? Because I had a HELOC on my home previously because we did this giant landscaping project. And when we started that HELOC, rates were in the low threes. And then at the end of it, rates were like I think that our rate on that HELOC ended up in the sevens. And I was like, oh my gosh, this payment has now, doubled what I was anticipating it was going to be as I'm paying off that HELOC. So with this program, does that rate vary or is it fixed? Explain that part, please.
You do have options. It's a phenomenal question because yes, most home equity lines of credit, with them being seconds, are mostly variable. This loan, we have the opportunity to fix it for 3 years or 5 years. It is still a 30-year term, but the interest rate lock period will either be 3 years or 5 years. You can also elect to have it float. This loan and the interest rates associated with it are not tied to the same rates and markets where conventional FHA loans are, where those interest rate markets are tied to Wall Street. They move aggressively, they move every day. This loan is tied to the CMT, which is the constant maturity treasury. It moves at a much slower pace. It also only adjusts once a month.
Okay.
And so, for example, I receive an email the first of every month with the interest rates for this coming month. And that's what they are for the entire month, which is really nice. It has a bit more predictability.
It does, right. And then there are caps on, like, once you hit the 3 years or the 5 years, you could have you could anticipate that the rate would not exceed a certain percentage. And then at that point, does it just change every month?
Yes.
Okay.
If you don't refinance within that 3 or 5 year window, once we exhaust the lock period, it will adjust. It can and will adjust monthly. But one thing to always remind people is people are afraid of the old adjustable rate mortgages that they heard horror stories about, of people's interest rates doubling, balloon payments, things like that. You're only going to adjust to what the market bears at that moment. They're never going to adjust your rate to market and then more for profitability. You get to what the current market is giving you, which I think is really important because adjustable rate mortgages have a terrible stigma, unfortunately, due to poor use and lack of ethics during that time period of the mid 2000s. But those types of loans have been regulated out of the industry, and this loan is nowhere near that. I can't harp on that enough because this is the largest expense you're going to ever have. This is your livelihood, and I don't want you to think that you're going to be in a position where you can get really hurt by this.
Right. I think now would be a good time to jump into the screen share and to show me the website where you can compare the all-in-one loan to a more traditional loan and really see what you're saving over the life of the loan in terms of interest.
Fantastic. Yeah, let me jump on over. We'll jump into this.
Okay, here we are on the website, the allinOneLoan.com website, and Shawn's going to walk us through an example of what it looks like to, comparing this kind of loan to more conventional loans.
Yes. So allinOneLoan.com, it's a free website. You don't have to access or input your information. We're not here to gather contact information or social security numbers. It's just a way for you to utilize a free online tool to see if this is a fit. Most importantly, I don't want people to think we're pushing this on people. I want to see if it's a good fit because it can provide a great financial outcome to you if it is. And so allinOneLoan.com, you can scroll down a little bit and we're going to get to the interactive comparison simulator portion of the screen. And this is where you can set up and see on an apples to apples comparison how the all-in-one loan stacks up for you versus other loan programs such as 30-year fixed, conventional options, or jumbo loans, whatever you're seeking. We're going to see how this meshes for you. So we'll go to the get started. There's a drop down here, start new simulation. Already have that selected. We'll move to the next page. Now what we're comparing is we're building out the simulation based on the other loan you're looking at. So for example, here we're going to compare this to a new loan because you're going to be purchasing. You can refinance into this loan at any time. So there are drop-down options to refinance. Intended occupancy, for this case, we're going to be looking at a primary residence. There are options to purchase second homes and investment properties using this loan, which is really important. The application to this on investment properties is incredible. We'll do a second video on that because it's really life-changing from the investment standpoint. But we'll compare the new loan, primary residence here. For the simulation I have, we're going to pretend that the home you're buying is $690,000. Loan amount we're setting at $621,000. That's based on the minimum down payment of 10% down. We will be comparing this to a 30-year fixed at 6.25%. I think that's a pretty fair interest rate in today's market without knowing people's credit scores, because once you qualify for the all-in-one, the rate's the rate. But depending on what your credit's at, and I don't know if you guys have heard about the new loan level price adjustments or costs that are associated with interest rates in the market, based on your credit score and down payment, your rate could be worse than what you think it's going to be, which is unfortunate. But we'll base it on 6.25%. What you'll see right here is $3,823.60 a month. That would be your monthly principal and interest payment on a 30-year fixed if you borrowed $621,000 at 6.25%. So now we're going to go to the next screen. One aspect of this loan that is very, very unique is where we have a tethered checking and savings account to your mortgage. And this, in my opinion, is where the horsepower of this loan really comes into effect. You're able to utilize your income towards the principal balance of your mortgage to reduce your interest. And so what we're doing here is we're going to take a look at what your net monthly income is. I put the emphasis on the word net because we're only looking at what money is actually hitting your account because that's what's going to impact your loan. So for the scenario, I'm estimating that this family buying a $690,000 house, they're going to be earning about $10,000 a month take home. So I have that they get paid $10,000 monthly. You can put whatever income you want in here. Keep in mind net. You also have drop down options where we can set up your pay to be weekly, bi-weekly, semi-monthly, monthly, quarterly, etc. It's important to keep this as accurate as possible because your income is helping reduce your interest, and the timing of your income actually matters. So we want to make sure we're being very specific to people's situations. So you'll see that we have our annual deposits there of $120,000. Going to the next page, we're analyzing your spending habits. With the tethered checking account, we anticipate that you're going to be depositing your income into this account and still spending out of it. We're not asking you to change your lifestyle. I'm just asking you to redirect your deposits. With this bank account, it is fully FDIC insured. You have online banking, so you can do online transfers and wires. You have a debit card and a checkbook that comes with this mortgage and bank account as well. I know you may love Chase or your local credit union, but we're going to see in a second what impact by using this account properly, what that can do for you and your family. So once again, $10,000 a month of deposits. We've got a traditional loan payment, so that would be your principal and interest on a 30-year fixed. We're estimating taxes and insurance for this purchase to be near $892 a month. That might be on the high side of things, but it's going to be a fair estimate on both programs. So we'll just leave that as is. And then we're going to estimate that this family holds on to 10% after their monthly spending. And when I say monthly spending, I mean everything: gas, groceries, Netflix, gym memberships, soccer cleats, Dairy Queen, absolutely everything. So at the end of every month, thinking of it from a traditional savings account standpoint, because your money's going into a bank account one way or another, and you're using that money spending out of that bank account. So we're going to anticipate that you hold on to $1,000 at the end of every month. Now let's see how they compare. So on the right-hand portion of the screen, you'll see that for the traditional 30-year fixed mortgage, you borrowed $621,000. Thanks to today's interest rate, you pay $755,000 back, bringing your total cost to purchase this home close to $1.3 million. Now, that's if you stay in the house for 30 years and stay in the mortgage. We both know that you're most likely going to refinance. Your average American stays in their house for about 8 years anyways. They stay in their mortgage for even less. People tap into their equity. People will refinance in and out of different programs depending on the lifestyle or life events. But to look at it from a totality standpoint, because we need to, that this is very important. On the left-hand side, now we see what the all-in-one loan can do. You borrow the same $621,000. You make the same amount of money. You spend it the same way. But thanks to using your income as principal payments on your loan, because the all-in-one loan takes your income, applies it to the principal balance of your mortgage first, and then bills you for the interest later. Thanks to the utilization of your money, we're able to save, in this case, $235,000 worth of interest cost over the life of this loan. Also puts you in a position that you paid your house off in 18 and a half years rather than 30 years. And that's how we're able to get to that position where we're saving $235,000 to buy the same house with the same money. And so one thing that I think is really important for people to know, and I'm a stats guy, so I love the big bullet point stats. The average American has enough money flowing through their checking account to pay off their home in 5 years. Of course, that means you're not putting money towards anything else, which is absolutely unrealistic. But I do think it provides a good perspective as to how much money we actually touch in our lifetime. And if we just tweak what we're doing with it and where we put it, it can have an outrageous impact without having to just revamp your life. There's, of course, the naysayers would say, well, why wouldn't I just get a 20-year loan? Why wouldn't I just pay a little bit more towards my 30-year fixed mortgage? One thing to know about an amortized mortgage is all payments are not the same. If you've ever seen an amortization schedule, it's painful to look at because on a 30-year fixed loan, yes, you might be paying $3,800 towards principal and interest. 1,000 of that might go to principal on the first payment. I'll bet you it's less. And so when you add extra money towards your monthly payment, it's not lost. It does help speed up your repayment, but it pays off the end of the loan first, which is, those are the years that more of your money is actually going towards principal. So
Right.
it's less effective than you really think it is. Where
Yeah.
on the all-in-one loan, all of your money goes towards principal now to reduce your balance now. And because this loan recalculates your interest charge, not your interest rate, but your interest charge on a daily basis, you're actually paying off from the front end, which is the most expensive years that I mentioned. So that's where this loan is able to take the same metrics that we use to get to the traditional loan. That's where we're able to create this upside of $235,000.
Right. Is all that savings on interest.
Yes.
Yeah. And you did a great example when we were talking before filming this video about like if you got paid on a Friday. Do you remember that example?
Yes, no, absolutely.
Yeah, because I think that was a helpful illustration.
So I know I've had some pushback in the past of people saying, well, okay, great. All my money from my paycheck goes towards my principal, but I need that money. It's my livelihood. Of course, we get that. We anticipate that. We built that into this calculation. And so a great example of how impactful this can be, I look at it from, let's look at a 3 or 4 day window. So let's pretend today, we're filming this on a Friday, but let's pretend it's Thursday right now. So your loan balance is $500,000. You have an outstanding principal balance of $500,000. You're going to receive a paycheck tomorrow for $5,000. That's your net. You get paid every other Friday. So as of right now, your interest is based on $500,000. Tomorrow morning, you're going to receive $5,000 deposit. That is immediately applied to the principal balance of your loan. So for Friday, you pay interest on $495,000. So if your interest rate on this loan was 7.5%, you're now saving 7.5% on $5,000 for that one day. Might not sound like a lot, but you compound that over time, it is a lot. So looking at it from throughout the weekend, right? If you received $5,000, you're not going to go spend $4,800 of it. Most likely, maybe you do have some large expense coming, but on a regular basis, you're going to receive that deposit of $5,000. Maybe you and your family go out to dinner. That's $200. Great. By Saturday morning, you have spent $200. So looking at it, taking a step back, your balance went from $500 down to $495, back up to $495, $200. Let's say you spend another $500 throughout your weekend on miscellaneous stuff, gas, a trip to the zoo, whatever it is. So roll around a Monday morning. Now your mortgage balance is back up to $495,700. You have a net savings of 7.5% on $4,300 over a 4 day window. Even if you moved the money out of the account following that and only saved on those 4 days every month, the compounding effect of that would save you tens of thousands of dollars over the life of your loan. And we've actually found this loan will change your spending habits in a positive way, because we're all competitive, where we like, whether variances or the level of competitiveness from person to person can change. But once you start to see every other Friday your mortgage balance goes down by $5,000, we like it. We become
reinforcing.
addicted. Oh my gosh, look how fast I'm paying my home off. All of a sudden, when you're at Pottery Barn, ooh, do I really lose? That chair's $1,000.
But you're also now losing what your savings on the interest by spending that money. Yeah.
Correct. And that's another thing that comes up. People are like, well, wait a minute. Now I'm charged interest to borrow my money. It's my money.
Yeah.
That's not true. The same way that your savings account currently pays out an interest rate and pays a dividend on that. You're just no longer earning the interest savings on that $1,000. You're not getting charged 7% interest on $1,000. You're just no longer saving the interest
saving
on
it. Right.
And so to me, those are very different. And so I just like to highlight that, because it is an objection we get often, is people thinking that, well, all of a sudden I'm paying 7.5% interest to go to dinner like it's a credit card. But that's, there's some tremendous application towards this. I like the fact that when going through the simulation, you tell me what you make. Tell me how you spend your money. Let's figure it out together, because more often than not, there is a better way to be more efficient with the money you're already earning and you're already spending. And so
you're just putting all of it to work on the front end.
Yes.
Yeah.
You actually can have your cake and eat it too.
Yeah. No, it's a great program. I wish I would have known about it a couple of years ago.
Yes. So, and that's
better late
the opportunity for folks to refinance into it is great. I actually had a client a couple months ago that they refinanced their 30-year fixed mortgage that they got about 3 years ago at 3%. We refinanced them into this loan, which people are like, wait a minute, you have 3% money and you can still make sense of this? Yes. And for that person, access to their equity was paramount. That was very important to them. And this gives you that ability, because at any point during this 30-year window, you can reach into that bank account and pull out $30,000 because you want to remodel the kitchen. You want to pay for your kids' college. You want to invest in your business. You want to buy your kid a car, braces, go on that once in a lifetime trip. I'm not advocating that you use this loan as a piggy bank to travel the world. But what I do want to highlight is it is unparalleled access. You don't have to, there's no, you don't have to request to borrow money. You have a debit card. Just like the debit card you have right now, you swipe it to get groceries.
Right.
You use it to buy.
So do a lot of people just move all of their banking then over to this and like
Yes.
ditch their big banks or whatever it is, or credit union?
Yes, they do, because
okay.
the power of this program is having your money flow through this account. You don't have to do it that way. But once you see what it can do, why keep your money at Chase?
Why wouldn't you?
Why keep your money at Wells? They're not paying you 7.5% for keeping money in a savings account. We are.
Yeah, no, this is a great program. So I'm going to put together a little handout to for anybody watching this video who wants more information, and I'll put your contact information on there with your email and your phone number and a link to this website. So anyone watching this video, go down to the description below and look for the link to the handout, and then you can get all of this great information.
Fantastic. And it's very interactive. Of course, reach out if you guys have questions, but I challenge everybody to take the couple minutes and input what your net income is. Take a look at what you hold on to at the end of every month and see what it can do for you. Because over the last couple of years, homeowners have seen an outrageous increase in their equity. And I found a lot of people want to move, but they're like, oh, my interest rate's 3.25%, my monthly payment is $2,200. I'm married to this, but maybe you've outgrown that house. Maybe you have kids, and now school district matters a lot more than it used to. You may find that this loan can provide you the opportunity to still get 3% money. And you're sleeping on a mountain of equity. Let's put it to use. Get into that better neighborhood. Buy that rental property.
Yeah, it definitely opens doors. I think a lot of people just are assuming that are closed right now because of how rates are. So.
Oh, absolutely.
Yeah. Well, thank you so much for your time. Anybody watching, again, just take a look at the handout in the description below, or contact me directly if you want more information. And Shawn's pretty easy to get a hold of, as am I. So looking forward to helping you if you have any questions.